So for the first time, the rate of growth of the Bitcoin supply is going to drop below the long-term rate of growth of gold. So long-term, the growth rate of the gold price, the gold supply, is about 1%. With this halving, Bitcoin's growth, the supply growth, is going to drop from 1.9% to 2.9% below that of gold. Now here's another difference between gold and Bitcoin. When the price of gold soars, what happens? Miners crank up and the supply increases. That cannot accelerates, the supply growth accelerates. That cannot happen with Bitcoin. If, as the price has gone up, the supply growth is not changing at all. It's 1.9% at an annualized rate now. In April, it will drop to 0.9%. And the history is miner difficulty will increase. There will be some dislocations, perhaps, in the market, just as people understand how is this all going to play out, especially those new to this ecosystem, and then it usually takes off. It's usually very good for Bitcoin. By definition, the price for any commodity is determined at the margin. If at the margin supply growth is going to be cut in half for a commodity, that's huge.
In a surprising turn of events, both Bitcoin and gold have surged to new record highs, signaling a departure from the typical market trends. Analysts attribute this unusual phenomenon to the current macroeconomic landscape, where inflation and interest rates are dominating investor sentiment. In 2024, Bitcoin surged, surpassing $73,000 before correcting slightly, with a 75% increase since the year began, fueled by SEC-approved ETFs in anticipation of the upcoming halving event in April. Meanwhile, gold has quietly climbed to around $2,159 per troy ounce, bolstered by central bank purchases, aiming to diversify holdings amid dollar uncertainties and expected Fed rate cuts. But despite both assets becoming extremely successful, ARK Invest CEO Cathie Wood believes that Bitcoin will be the one to reign supreme. In a recent interview, Cathie Wood shares her insights on Bitcoin's performance after the halving, suggesting that it will perform tremendously, ultimately becoming superior to gold. She believes that Bitcoin is digital gold and enumerates all the reasons why Bitcoin is poised for excellence for this year and the many years to come. We will now bring you clips from the interview, where Cathie Wood provides her latest insights. As we show you these clips, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more similar videos. Make sure to stay through the end of the video, where Cathie Wood explains how Bitcoin became a risk-off asset. We hope you enjoy the video.
So gold, the value of gold in the marketplace today is $14 trillion. The value of Bitcoin in the world today is $1.4 trillion, 10% of gold. Digital gold is much more convenient than traditional gold, especially if you want it in cold storage, right? They know they have to be in stocks, they have to diversify, they have too much cash, so let me play it safe with an index. We don't think that's playing it safe, actually. We don't, because there is so much innovation. If you talk about robotics, energy storage, artificial intelligence, blockchain technology, multi-omic sequencing, we have never seen this kind of innovation before. And what is the other side of truly disruptive innovation? Is creative destruction. Sure. So I think this seeking safety in indexes is not going to end well. In the late 90s, what happened? We had the internet, and everybody said, oh my gosh, where's this going? This is going to the moon, right? Too much capital chased too few opportunities too soon, and it ended badly, right? It ended badly. What we're going through right now is the opposite of that. We've got everyone hugging benchmarks. They're running for the hills. They're scared of long duration, volatile strategies. They seem risky because innovation is it's controversial. It's controversial. These ETFs are not like traditional ETFs in that you're dealing with underlying assets that fork and halve, and there are airdrops. So it's not like the traditional equity or bond ETF. As both institutions and individual investors and advisors and asset allocators are doing their homework, the light bulb is going on. And basically they're saying, again, they're beginning to understand that, wait a minute, this is nothing but the internet financial system rolling out. This is a big idea. And it's Bitcoin, of course, but then there are smart contracts, DeFi, decentralized finance. We're starting to use this term internet financial system. It doesn't sound as defiant. Okay. It's just technology, at work, and actually making up for lost time. The early developers were in the 80s and the early 90s. Again, they didn't conceive of commerce or financial services. Now we need to catch up. The pent-up demand has been in a lot of places. Retail, it has been there because, as I mentioned, people don't want to deal with wallets and hardware and all of the friction that you have to go through to self-custody. And then on the institutional side, the SEC gave Bitcoin the green light, and so institutions understand this is a new asset class. They have been studying it, and I'll tell you why they've been studying it. In 2018, Cambridge Associate, which is a consultant to endowments and foundations, it came out with a study and basically said, you may not like this, but you better study it because this could be a new asset class, and we truly believe it. It is a new asset class, which means that any institution who is looking for low correlations of returns among their assets needs to look at Bitcoin and other crypto assets if they want to increase their return per unit of risk.
In the study that Wood mentions by Cambridge Associates in 2018, institutions were advised to study Bitcoin as it could potentially become a new asset class. This recognition of Bitcoin as a distinct asset class is crucial because it offers institutions the opportunity to diversify their portfolios and seek low correlations of returns among their assets. In other words, by adding Bitcoin and other cryptocurrencies to their investment portfolios, institutions can potentially increase their returns per unit of risk, thus enhancing their overall portfolio performance. Therefore, Wood suggests that institutions are now seriously considering Bitcoin and other crypto assets as part of their investment strategies. Overseas investors have also shown keen interest in Bitcoin ETFs, with reports indicating that Thailand's Securities and Exchange Commission has revised its regulations to allow private funds to invest in spot Bitcoin ETFs traded on US exchanges. Similarly, Brazil has recently adopted a similar approach, permitting investors to participate in BlackRock's ETF through depository receipts. Let us now go back to the interview as Cathie Wood shares more of her insights.
Many people are beginning to understand the scarcity value associated with Bitcoin and other crypto assets. And there's something really interesting happening in the world today that is macro, that people aren't connecting directly, but I think they will. In fact, they're not even talking about this. In Nigeria, in June of last year, the government let the Naira, local currency, float. It's a new administration, let it float. It's an oil-rich country. We can support it. Guess what? It's lost 2/3 of its value. And the government is now detaining 2 people from Binance and is insisting, that they need to learn who has been manipulating the Naira with Bitcoin, which we don't believe that's what's going on. What we believe is there is a flight to safety. And we saw this with the regional bank crisis last year. And we had NYCB recently, again, a reverberation of the regional bank crisis. That is also macro. The deposits system-wide are still going down. The problem has not gone away. Bitcoin is an insurance party against counterparty risk. Banks have counterparty risk. Bitcoin does not. And it is an insurance policy to preserve purchasing power and wealth, right? So I think that's happening in Nigeria. I think there's an insurance policy here against, wait a minute, I don't understand, the banking system is still showing deposit outflows. Maybe I should have a little insurance policy because I don't understand that. So let's go back to what it is. Is it a risk-on asset that acts like everything else? During some markets, yes, it is right up there with stocks and bonds in some cases. But the important thing we've learned in the past year, and this is where the low correlation comes into view, is that during the regional bank crisis, it was a risk-off asset. Then you'll notice the regional banks keep going down. Look at the chart and look. Actually, the chart since then helps make the point I'm making. It has gone straight up. Where have regional banks gone? Bitcoin led, maybe by a few days, but Bitcoin took off because I remember saying during the regional bank, I said, wait a minute, Bitcoin's going up. What's going on here? And I can tell you when we also saw this. When we first gained exposure to Bitcoin at $250 versus the $74,000 now, and we believe the journey's just begun. When we took our first exposure, we were on edge every day trying to figure out, okay, how will this behave? And when Greece threatened to leave the European Union, and we got fear again in the euro of reverberation of the European sovereign debt crisis, Bitcoin went up. Bitcoin up on those days.
As the next halving event approaches, slated for April, investors and enthusiasts are closely monitoring its potential implications for Bitcoin's price and market dynamics. For the first time, the rate of growth in Bitcoin's supply is expected to drop below the long-term growth rate of gold. This development underscores Bitcoin's unique scarcity and finite supply, distinguishing it as a digital asset with store-of-value properties akin to precious metals. One key distinction between Bitcoin and gold lies in their supply dynamics. When the price of gold surges, miners respond by increasing production, leading to a rise in the overall supply of gold. In contrast, Bitcoin operates on a fixed supply schedule, dictated by its underlying protocol. Regardless of price fluctuations, the rate of new Bitcoin creation remains constant until a halving event occurs. This means that as Bitcoin's price rises, its supply growth rate decreases, enhancing its scarcity over time. Despite the potential for short-term volatility, historical precedent suggests that halving events are typically bullish for Bitcoin. Previous halving events, such as those in 2012 and 2016, were followed by significant price rallies, with Bitcoin reaching new all-time highs in the months and years that followed. This historical pattern has led many investors to view halving events as key catalysts for Bitcoin's long-term price appreciation. While short-term market disruptions may occur, the historical significance of halving events suggests that Bitcoin's price trajectory remains bullish in the long term, making it an event of considerable interest and anticipation for investors worldwide. Do you believe Bitcoin has the potential to become a superior asset? And if so, what factors contribute to this belief? Share your insights in the comments. If you found this video useful, please consider giving it a like and subscribing to our channel for more valuable content on cryptocurrencies and finance. Thank you for tuning in, and we look forward to seeing you in our next videos. As always, happy investing.